In a real 50% stock market crash, gold and silver don't save you first. At the start, they get sold like everything else, and that's where most people get wrecked. Not because the metals suddenly stopped being money, not because the thesis died overnight, but because a true crash is not a story about value. It's a story about collateral, margin, and who needs cash right now at any price. And that's the conflict most people miss. The mainstream narrative says stocks crash, gold wins. The market's first move says stocks crash, everything liquid gets turned into cash. And the hidden mechanism underneath that first move is the entire game. Gold and silver often become the emergency ATM for portfolios because they among the few positions you can still sell in size when everything else is gapping, freezing, or hitting circuit breakers. That's not drama, that's plumbing. And if you understand that plumbing, you stop treating the first drop in metals like betrayal, and you start treating it like the opening act before the real pressure starts. Because the real question isn't, do gold and silver go up in a crash? The real question is, when do they get sold? When do they stabilize? And when do they reprice? And what tells you which phase you in before your emotions make the decision for you? And later in this video, I'm going to give you a near-term checklist, the exact signals to watch in the next week or two if the tape starts to break. The levels that matter because they force behavior and the one metric that flips the whole setup from liquidation noise to regime shift. But first, you need to see what a 50% crash actually is. A 50% crash isn't a pricing debate. It's a collateral event. It's a forced reordering of the entire financial food chain. When equities are down 10%, people argue about valuation. When equities are down 30%, people argue about recession. When equities are down 50%, nobody cares about narratives. They care about survival. They care about meeting margin. They care about funding. They care about not being the next forced seller. And in that environment, correlations don't politely diversify. They spike toward one. Everything moves together because everything is being turned into the same thing, cash. That's why the first phase of a true crash is almost always sell what you can, not sell what you should. And gold and silver are typically in the can category. They're liquid. They trade around the clock. They have deep futures markets. They have ETF ecosystems. They have bids even when other markets are gasping. So if you're a levered fund, or you're a dealer managing risk, or you're a portfolio that suddenly got a margin call because your equity book imploded, the fastest way to raise cash is not to sell the thing that was down 40% and has no bid. The fastest way is to sell the thing that still has a bid. That's gold. That's silver. That's why in the first liquidation wave, you can see gold drop even when the world feels like it's ending. And that's why people get psychologically trapped. They bought metals for protection, then the protection appears to fail at the exact moment fear peaks, and they capitulate right before the market transitions into the phase where metals actually do what they were built to do. But that transition is not emotional, it's mechanical, and it happens when forced selling exhausts and the macro regime takes over. Here's how the movie usually plays out when it's real. Phase 1 is liquidation. It's blunt, it's ugly, it's fast. Funds sell what's liquid, not what's smart. Brokers hike margins. Risk desks cut exposure. Volatility models scream. And selling becomes self-fulfilling because the act of selling raises volatility, which raises margin, which forces more selling. That's the spiral. Phase 2 is stabilization. Not because everyone feels better, because the forced sellers finish, they meet margin, they reduce risk. They're no longer dumping metal to save their equity book. The tape stops being purely cash hunting. And that NZ sign, when you start to see something subtle, the metal ES relationship with the dollar, with real rates, with credit stress, with policy expectations, begins to reassert. Phase 3 is repricing. This is the part people think happens immediately. It doesn't. It happens when the market collectively realizes the crash isn't just a stock story. It's a money story. It's a policy story. It's a currency credibility story. It's a balance sheet story. And in that third phase, gold tends to act like what it is. Global collateral that doesn't give someone else liability stamped on it. Silver can act like a wild cousin, sometimes lagging early because it trades like a leveraged risk asset, then catching fire later when the market senses reflation, supply tightness, or just a violent positioning squeeze. And that last part is where the spread, the curve, and the paper versus physical signals start telling the truth. Because price can lie, spreads often can't. And that's not the part that gets covered on the evening news. Now let's get specific about the hidden detail, the collateral valve. In a crash, the market is not one big crowd with one big opinion. It's a chain of obligations. Retail has opinions. Institutions have constraints. Dealers have risk limits. Funds have margin requirements. And the system has one brutal rule. If you can't meet your obligations, you don't get to keep your thesis. You get liquidated. That's why the early crash behavior in metals is often dominated by forced flows, not fundamentals. If your equity portfolio is bleeding and your prime broker is calling, you can't phone them back and say, I'm right long term. You need cash today, and the easiest cash is whatever is liquid and not already destroyed. So gold and silver become that valve. And here is the twist, that forced selling can push prices down even while physical demand is rising underneath. That is the paper versus physical tension. It's the reason you can see futures price drop while coin premiums jump. It is the reason you can see the headline price look weak while availability in the real world tightens. It's the reason people who only watch the spot chart get whipsawed, because the spot chart is reflecting paper flows in the moment. Physical markets move with different frictions, lead times, refining capacity, logistics, inventory categories, and real world buying behavior. And in a stress event, those frictions matter more than opinions. That's where the real pressure starts. Because if paper is being dumped to raise cash while physical demand doesn't blink, the system is building tension. Not conspiracy tension, incentive tension, market structure tension, the kind of tension that shows up in spreads, in term structure, in delivery behavior, in leasing, in premiums, in who is willing to part with metal now versus later. And those are the signals you need to watch if you want to understand what really happens in a 50% crash. Now let's split the family. Gold and silver are not the same animal in a crash, even though they rhyme. Gold is the macro hedge people want in a panic because it's tied to monetary credibility, it's tied to reserves, it's tied to the concept of settlement without counterparty risk. Silver is a hybrid. It has monetary DNA, but it trades with industrial blood. It's smaller, it's thinner, it's more volatile, it attracts speculative positioning, and in a crash, that cocktail matters. Silver often gets hit harder in phase one because when risk explodes, people de-lever. And silver is where leverage lives. It can move like a risk asset when liquidity is thin and margin is rising. It can underperform gold early. That's not a failure of the thesis. That's the personality of the instrument. But, and this is the part that flips the whole setup, silver can also snap back harder later because S is reflexive. When forced selling ends, when shorts are crowded, when the market starts sniffing policy response, when the dollar stops being the clean haven and starts being the pressure point, silver can go from sold for cash to bid for scarcity faster than people expect. And that snapback can be violent because the market is smaller and positioning shifts quickly. That's why the question, what happens to gold and silver in a crash, is incomplete without the time axis. What happens on day 3 is not what happens on month 3. And if you don't separate phases, you'll misread everything. So let S talk about the core mechanic that drives the early phase, margin and forced selling. Picture a large fund with a diversified book. They have equities, they have credit, they have some commodities, they have gold, maybe they have silver. They're running leverage because leverage is how institutions turn small edges into big returns. Now equities start dropping fast, volatility spikes. The fund's risk model marks their portfolio as riskier. Their prime broker requires more margin because the collateral is less reliable. Futures exchanges can raise margin requirements too when volatility rises because they're protecting the clearinghouse. That's not manipulation, that's risk management. But the outcome is the same. The fund needs more cash to hold the same positions. If they don't have it, they must cut. They must sell. They can sell the losers, but the losers are already down and often illiquid. Or they can sell the winners or the liquid hedges, gold and silver, and raise cash immediately. This is why the hedge getting sold is a feature of the crash, not a contradiction. It's why gold can drop during a panic. It's why silver can get slammed. And it's why you can see short-term correlations break your expectations. The market is not pricing your thesis. The market is meeting margin. And when margin is the dictator, the chart will do things that feel irrational. But it's rational inside the system. And that's where people lose trust and get shaken out. Because if you expected a straight line hedge, you'll interpret the first downdraft as, I was wrong. The real interpretation is, the system is liquidating. And the next detail is what flips the whole setup. How do you tell when liquidation is ending and repricing is beginning? You don't guess. You watch the structure. You watch the curve. You watch the spreads. You watch the behavior around key levels. You watch how price reacts to bad news once the market has already been punished. You watch whether dips are bought quickly or whether bids vanish. And you watch whether physical tightness is showing up even while paper is chaotic. That is the scoreboard. Let's get into the paper versus physical idea without making it mystical. Futures markets are the arena for price discovery. They're deep, they're liquid, they're where hedgers and speculators collide, but futures are also a margin-based system. You don't pay the full value, you post collateral. That means futures are extremely sensitive to volatility and margin changes. Physical markets are different. They involve actual metal, actual delivery, actual refining, actual transportation, actual fabrication. Those markets have frictions. They also have different participants, mints, refiners, industrial users, wholesalers, jewelers, coin dealers. Vaulting services. In a crash, the futures price can be driven by forced liquidation while physical demand can tighten because people seek tangible hedges or because industrial users secure supply. That mismatch can show up as rising premiums or delayed delivery times, even if the headline spot price is down. And that mismatch is one of the most important truth leaks in a stress event, because it tells you whether the move is purely financial or whether there's underlying scarcity or demand that refuses to disappear. But you can't treat premiums like a guaranteed signal either, because premiums can rise simply because supply chains get clogged. Refining capacity, logistics, retail bottlenecks, dealer inventory management. That's why we need a proof stack, not a single indicator. We need multiple layers, each pointing in the same direction. Here's the proof stack you should think about in a 50% crash scenario, and I'm going to translate each one into so what terms. First, the term structure, the curve. Is the market paying more for metal now than later, or later than now? Backwardation, front months priced above later months, can indicate stress in immediate availability or strong immediate demand relative to inventory willingness. Contango, later months above front, often reflects normal carry costs, storage, insurance, financing. In a crash, if you see the curve behave strangely, it's a clue about what's scarce, cash or metal. If contango steepens because financing stress is rising, the market is screaming about the cost of holding. If backwardation appears or deepens, the market can be screaming about near-term tightness. And the so what is simple. The curve forces participants to act. If rolling futures becomes expensive, it pressures longs. If near-term tightness spikes, it pressures shorts and forces a different set of decisions. Second, inventory signals. You don't need exact numbers to understand the principle. Exchanges and vaulting ecosystems distinguish between categories. Metal that is deliverable versus metal that is simply stored. Metal that is registered for delivery versus eligible but not committed. Metal that can move versus metal that is spoken for. In stress, the composition matters more than the headline. If deliverable stocks shrink, or if the market starts paying for immediate delivery, that changes the balance of power. And the so what is that it can tighten the effective float, making squeezes more likely and making price more sensitive to flows. Third, spreads, especially the behavior of nearby contracts versus deferred. Spreads are where stress shows up first because spreads reflect urgency and carry. A flat price can look calm while the spread is screaming. If the spread is moving aggressively, it's telling you that something is shifting in funding, availability, or positioning. And the so what is that spreads can front run the headline move. Fourth, institutional flows. Watch how large pools behave. ETFs can see outflows during the forced liquidation phase, then inflows when the regime shifts. Large investors can rotate into gold as equity volatility remains elevated. Official sector demand can be supportive over longer horizons, but it won't necessarily stop the first wave of deleveraging. The so what is that flows tell you whether big hands are treating dips as inventory or treating rallies as exit liquidity. Fifth, cross-market comparison. Gold versus the dollar, gold versus real yields, gold versus credit spreads, silver versus copper, silver versus oil. Not because you need a PhD, because relationships tell you what the market is pricing. If gold starts rising, even as equities remain weak, the market may be shifting from cash panic to policy and currency risk. If silver starts outperforming gold after a brutal sell-off, that can be the market sniffing reflation or positioning snapback. The so what is that relative strength can reveal phase changes before the headlines do. Sixth, on the ground symptoms, premiums, availability, delivery times, industrial procurement behavior. This is where you avoid getting tricked. You don't treat one dealer premium as gospel. You look for broad-based signs that physical demand is either tightening or loosening. The so what is that physical reality can remain firm even when paper is chaotic, and that tension can eventually matter. Seventh, chart structure and levels. Not because lines on a chart are magic, but because levels are where forced sellers exhaust and forced buyers show their hand. In a crash, levels become behavior lines. If price slices through a level with no fight, liquidity is thin and sellers are still in control. If price tags a level and bounces violently, that can be forced selling finishing and opportunistic buying stepping in. And that's where you start building a map rather than reacting. Now, if you're hearing all of this and thinking, so are gold and silver actually safe in a crash? Here's the clean answer. They can be, but not in the way people emotionally expect. If you are using them as a volatility-free life raft for the first 72 hours of a liquidation storm, you're setting yourself up to panic. If you are using them as an insurance policy against monetary and policy consequences that often follow deep equity drawdowns, they have historically played that role better. But you still have to survive the opening act without letting your brain sabotage you. And that's where the psychology shield matters, because the market doesn't just move your P&L, It moves your identity. In a crash, the market will try to manipulate you with emotional whiplash. On down days, you'll get gold is failing narratives and everything is selling panic. On up days, you'll get crisis over relief narratives. And between them, you'll get the most dangerous message of all. You have to do something right now. That message is how volatility turns rational people into forced participants. Here's the shield. Separate trend signals from noise. Noise is violent movement caused by forced flows, thin liquidity, and margin mechanics. Trend signals are sustained changes in relationships and structure. How gold behaves relative to rates and the dollar, how the curve behaves, how spreads behave, how flows behave after the first shock. If you treat noise like trend, you'll overtrade and panic. If you treat trend like noise, you'll miss the repricing. So you need rules before the volatility hits. One rule: don't use leverage if your goal is protection. Leverage is how you become the forced seller. Another rule: don't anchor your belief to a single day's price action. In a real crash, intraday moves can be designed by structure, not by truth. Another rule: define what would invalidate your thesis in structural terms, not emotional terms. Gold went down today is not invalidation. Funding stress is easing, real yields are rising sustainably. The dollar is strengthening in a way that signals confidence rather than panic, and physical tightness is disappearing is a more meaningful invalidation set. You're not predicting, you're mapping. And that mapping is how you keep trust without becoming naive. Now let's bring in the why now calendar trigger, because timing matters and the calendar is not just a date, it's a risk engine. Crashes don't always begin at convenient times. They often accelerate when liquidity is thin and positioning is crowded. Think year end, think month end, think quarter end. Think around major options expirations. Think around policy deadlines or key central bank events. Why? Because large funds and dealers have to manage books into those windows. They rebalance. They roll exposures. They adjust hedges. They window dress. Liquidity can thin out as participants step back, which makes price more sensitive to flows. And when price becomes more sensitive, small pushes create big moves, and big moves trigger risk models, and risk models trigger forced decisions. It's a feedback loop. So if you're asking what really happens in a crash, you have to respect the calendar. A crash that begins into thin liquidity can create gap risk, moves that happen when you can DT respond cleanly. A crash that accelerates into a major options window can create gamma effects where dealers' hedging flows amplify the move. And this is where we touch the options, reflexivity without getting lost. If dealers are short gamma, they may have to sell as the market goes down and buy as it goes up, which can exaggerate swings. If they're long gamma, they may dampen moves. Either way, the hedging flows can add fuel. And while that's most obvious in equities, the second order effect hits metals through the same funding and risk channels. That's why, in a violent crash, gold and silver can whip around even if the longer-term thesis is correct. That's not a contradiction. That's the cost of living in a leveraged mark-to-market world. And that's the next detail. Even when you are right, you can still get shaken out if you don't respect volatility. Now let's talk about two scenarios because this keeps you grounded and it keeps you credible. Scenario one is the controlled pullback and retest. Equities fall hard, metals get hit in phase one as cash is raised, then metals stabilize and retest key levels. You'll see violent swings, but you'll also see buyers defending structure. In this scenario, confirmation looks like this. Gold stops making lower lows despite continued equity weakness. The dollar's strength begins to stall or behave differently. Funding stress remains elevated but stops worsening, and the curve and spreads in metals stop deteriorating. Physical tightness may remain firm or even improve. The invalidation in this scenario would look like persistent structural weakness. Gold fails to hold key supports repeatedly. The curve deteriorates in a way that reflects rising carry stress without any sign of immediate demand, and physical symptoms cool off. Scenario 2 is the continuation squeeze with gap risk. This is where the crash breaks something: confidence, funding markets, policy credibility, or simply the willingness of participants to provide liquidity. Liquidity thins, price discovery gets jumpy, and gaps become common. In this scenario, after the initial liquidation, gold can turn from sold for cash to bid for collateral, and moves can become discontinuous. Silver can go from hit hardest to squeeze hardest if positioning is offside and physical tightness or reflation expectations kick in. Confirmation here looks like gold rising while equities remain fragile, volatility staying elevated, the dollar's behavior becoming unstable or contradictory, and spreads signaling urgency. Invalidation would be a return to stable funding and a calm risk regime. Basically, the crash threat dissolves. And notice what I just did. I didn't promise you an outcome, I gave you a framework. That's how you maintain trust in a market that's designed to humble certainty. Now let's talk levels, but in the right way. In a crash, people love to throw numbers around like spells. That's not what we're doing. We're treating levels as behavior lines where participants are forced to do something. For gold, you're watching zones around recent consolidation ranges, recent breakout points, and major prior highs or retest areas, places where a lot of positioning was built. If gold breaks down through a major prior support with no bounce and no fight, that suggests forced selling is still active and liquidity is thin. The shield is pre-commitment and time horizon. If you're holding metals as insurance, you don't judge insurance by its hourly mark-to-market. If you're trading, you define your risk, and you accept that you can be right and still get chopped if your sizing is wrong. And that's the quiet warning most people don't want to hear. The thesis can be correct, and you can still lose money if you let volatility dictate your behavior. Because the market doesn't just test your analysis, it tests your discipline. Now, let's talk about the single underappreciated metric that reframes the entire story in a crash. The difference between liquidity stress and monetary stress. Liquidity stress is when everyone needs cash now. That's phase one. Monetary stress is when the market starts questioning the value and stability of the currency and the policy framework. That's phase three. Between them is the pivot. And the pivot is when the market starts pricing not just stocks are down, but the response to this crash changes the future purchasing power of money. That is when gold's role becomes dominant. And you don't need to predict it with certainty. You detect it with behavior. Does gold stop caring about equity down days? Does it start caring more about policy and currency signals? Does it hold up while equities keep bleeding? Do spreads and curves suggest underlying tightness or urgency? Does the physical market remain firm? Those are the clues. And if you're watching for what really happens, the answer is that gold and silver are not a single reaction. They are a sequence of reactions driven by what the system needs at each moment. First cash, then stability, then a new pricing regime. Here's the part you can use immediately. If a crash begins, don't demand that metals behave perfectly on day one. Demand that they give you information. If gold collapses alongside equities and the dollar surges and funding stress worsens, that's consistent with phase one. If gold begins to stabilize and respond differently while equities remain weak, that's the pivot. If gold trends higher while risk assets remain unstable, that's the repricing phase. Silver will likely exaggerate each phase, worse in the liquidation, wilder in the stabilization, potentially more explosive in repricing if the market shifts into reflation expectations or a squeeze dynamic. But silver is not a free lunch. It's a higher volatility instrument with different demand drivers and different positioning. So the what really happens answer is not gold up, silver up. The answer is gold and silver get stress tested by the collateral machine first, then they get repriced by the policy and currency machine. And if you understand that, you stop getting emotionally ambushed by the first move. Now, I want to give you a final practical framework to carry into the next week or two, the kind that keeps you calm if markets start moving fast. Step 1, decide your time horizon. Are you holding metals as insurance, or are you trading a move? If you can't answer that, volatility will answer it for you, and you won't like the result. Step 2, define your invalidation and confirmation signals in structural terms. Confirmation is not a green candle. Confirmation is relationship shifts, gold holding while equities are weak, spreads behaving in a way that suggests underlying strength, physical symptoms staying firm, and dips being bought with urgency. Invalidation is not a red candle. Invalidation is a regime that returns to stable funding, rising real yields in a way that signals confidence and disappearing physical tightness. Basically, the crash thesis dissolves. Step 3, accept the two scenario lens. Scenario 1 is controlled pullback and retest, painful but navigable. Scenario 2 is continuation squeeze with gap risk, violent, discontinuous, emotionally brutal. If you prepare for both, you don't get shocked by either. Step 4, watch the calendar, because thin liquidity windows amplify every mistake. If markets are into month-end, quarter-end, year-end, or major options windows, treat moves as more likely to overshoot. Step 5, protect yourself from the manipulation of your own mind. In a crash, your brain will want to do two things: freeze or chase. Neither is a strategy. A strategy is a predefined risk posture and a checklist. A strategy is knowing what you're watching and why. If you want to operate like a serious macro watcher rather than a headline tourist, the community is built around one identity: mechanics. First thinking, not hype first, not fear first, mechanics first. If you stay with that identity, the market can't jerk you around as easily. And if you want, you can use the comments like a war room. Drop what you're seeing in spreads, in the curve, in physical availability, in how gold is behaving relative to the dollar. Because in volatile regimes, the edge is often collective observation, not individual certainty. Just remember the last, most finance credible truth. Price can whip violently even if the thesis is correct. In fact, that whipping is often the mechanism that transfers metal from weak hands to strong hands. That's why the first phase is so psychologically destructive. It feels like betrayal. It feels like it didn't work. But if you zoom out and follow the plumbing, you see what's actually happening. The market is squeezing cash out of every liquid pocket before it reprices the meaning of money. And if a 50% stock crash is truly on the table, that repricing phase is the part you're actually here for. The move is not emotion, it's math. And the moment one key behavior line breaks, the math changes.